The following video is intended for educational and informational purposes only. All strategies and content presented are for demonstration purposes and do not constitute financial, investment, or trading advice. Some of the materials, including clips and concepts, are sourced from publicly available content from Fidelity Investments Learning and Investopedia, used under fair use for educational purposes.
We are continuing our look at options buying strategies. Specifically, we're going to cover the long put. We'll talk about why you might choose this strategy and walk through an example that shows the potential profit and loss if the price of the underlying investment rises, falls, or stays flat. So let's get right into those details. Long put is another term for buying a put. It's a strategy typically used by people with a bearish outlook on a specific investment. They're looking at an investment such as a stock or an ETF and are expecting its price to decline. They want a chance to profit from that price movement, but they also want to limit their downside risk. It's also a way to take advantage of the potential that options offer to augment your returns, because one options contract typically gives you the right to control 100 shares of the underlying investment for only the cost of the premium. Here's a hypothetical example to show how the long put works. Say you bought one XYZ put with a strike price of $42 and a premium of $2. Multiply that premium by the 100 shares in an options contract, and the put would cost you $200. This chart shows the potential profit and loss on the trade depending on whether the stock price has risen or fallen at the contract's expiration date. If your projections are wrong and the stock price is higher when the contract expires, you won't exercise it. That means you'd lose the $200 you spent to buy the option, which is the $2 per share premium times the 100 shares the contract covers. Your outcome is the same if the stock price stays flat over the term of the contract. That's because if the stock never falls below the strike price, your option won't gain any value, and once again, you'd be out the premium you paid. On the other hand, let's look at what happens if the stock price declines. In that case, your profit potential could be substantial. The maximum profit on this contract would come if the underlying stock fell all the way to zero at the option's expiration date, which isn't a very likely scenario, but it's helpful to know maximum potential gain and loss, because no matter how low the stock price goes, this contract has locked in your right to sell the shares at $42 until the expiration date. If the stock falls to zero, you could earn the difference between your strike price of $42 and zero, minus the cost of the $2 premium you paid. So in this case, you could earn up to $40 per share or $4,000 per contract. Ultimately, though, your total profit depends on how much the price has fallen by the contract's expiration date. And in order to earn any profit, you have to at least cover the cost of your premium. For this example, that means your break-even price at expiration is the $42 strike price minus the $2 per share premium you paid, or $40. The further the price falls below $40 before the expiration date, the more profits you'll earn. So that's how the long put works, and why it's an options strategy commonly used when you're bearish on the underlying investment. We'll be covering one more buying strategy in this series, and then we're moving on to options selling strategies, so stay tuned.